Hi, everyone. I'm Mark Sir, Product Manager at Saving for College, and on behalf of the whole team here, I'd like to welcome you to today's College Savings Month webinar. Each September, we mark this occasion by bringing you an expert panel to answer your college savings questions. Thank you to those of you who included questions during registration. There were well over 100 and a lot of really good ones, so we're very excited about that. We'll do our best to cover as many as we can. Obviously, we're not going to get to all of those, but if we're not able to get to your question, you can always find more resources on savingforcollege.com. We especially thank College Choice CD 529 Savings Plan for their generous support of today's webinar, and of course, our two panelists here, Marissa Rao and Joe Messenger. The Indiana Education Savings Authority was kind enough to give away a $500 contribution to a College Choice CD 529 plan. So we will be announcing the winner of that prize at the end of the webinar, so definitely stick around. To introduce the panelists, Marissa is Executive Director of the Indiana Education Savings Authority, which administers Indiana's College Choice Savings Plans. They've got $6 billion in assets and over 400,000 accounts. Marissa is a first-generation college graduate, paid off her own student loans in 2020, and currently has 529 plans for her 3 nieces. This is her second year serving as a panelist during our College Savings Month webinar, and we're excited to have her back with her practical experience on saving for education. So welcome, Marissa. And Joe Messenger is the co-founder of College Aid Pro, where he's on a mission to end the student loan crisis one family at a time. College Aid Pro's award-winning software helps families and financial advisors plan for all 4 years of college costs. And Joe is a staple of our webinar series, so we're thrilled to welcome him back again.
Thanks for having me.
I'd like to get started actually with a poll question before we ask the panelists some questions, just so we can get a sense of our audience. So I'll put that poll into the field right now. And the question there is, have you started saving in a 529 plan? So I'll give everybody a moment to answer that. And while we're doing that, I'll let you all know that we will be sending out a recording of the session afterward in case you miss anything. So don't worry about that. And we'll be sure to do so. So I'm going to go ahead and just give 10 seconds here. About 75% participation right now. Just give everybody a chance to answer that yes or no. And then I will end the poll and share our results. So this is great news here. Hopefully you can all see that. Close to 3/4 of the audience has actually already started saving in the 529 plan. So hopefully we'll be able to help you guys maximize your contributions here as you move forward. That's terrific. So I've got just a general outline, some of the most common questions that we've seen come through registration. Something I always really like to start with, and I'll start here with Joe, given his expertise on kind of late stage college planning and kind of paying that college bill. How are we setting a good college savings goal? When we look at a sticker price of a private institution, we might think that's completely unrealistic to save, the necessary monthly amount to get to that sticker price. So what are you advising people on how to think about that?
Yeah, it's hard to frame up. I think interesting thing is we're in the first generation of people that are paying off their own student loans well into their kids' teenage years. So you're trying to balance competing needs. But when it comes to saving for college, I'd say start with something, because if you look at the numbers and you look at if schools go at 3%, but if you have a newborn today, they're going to cost around $200,000 for an in-state school and $400,000 for a private school. Those are the sticker prices. So if you look at those numbers, you might just throw up your hands and say, why would we even get started? But I say start with something, even if it's $25 a month. And the big thing is, from a target standpoint, understand that about 1/3 of college is paid for from grants and scholarships. You need to be a smart shopper, but when we set targets, we try and encourage people to say, what type of education do you want to save for? Is it in-state, state school, or private institution? Because those goals will change. And I'll tell you, if you save from the time a kid's born, $250 a month, you'll have about $100,000 when they go off to school. So, that's just to give people a kind of a frame of reference. But what I say is, like, when we say set your target, is it private or state, and start something, because anybody can contribute to a 529 plan. Right. So it takes a village to pay for college. So when we talk about setting that goal, how much to save, start something, get something going on a regular basis. And what I would say too, how much to save, if you start small, every time you get a raise, just like with your 401k, raise that contribution amount. So if you start at $25 a month, when you get a raise, move it to 50. When you get a raise, move it to 75. When you get a raise, move it to 100. So stair step your way in, get something started, and then encourage grandparents, aunts, uncles that don't have kids to contribute to these plans. So because that number is daunting, but if you start with something, start that saving habit, pay yourself first, setting a target of, a lot of times it's, if you can say, hey, if we can save for at least half of a state school, that's a good target for people, for some people. And then if you're saying half of a private school, because when you get there, scholarships, grants pay for about a third, some, reasonable student loans, but, starting something is really what we encourage people. Because if you look at the number, it might say save $843 a month, and that's probably not doable if you're a 30-year-old couple. So just get started with something. And as I said, stair step in and encourage other people to contribute.
That's terrific advice, Joe. I appreciate that. And Marissa, is there anything you'd like to add? I thought you had phenomenal advice on our pre-session where you had said, just save as much as you can. And I think that's really the right answer there. But is there anything else you'd like to add?
Yeah, absolutely, Mark and Joe. I think the trick to this, because there's sticker shock is a real thing. And so my couple of points for folks are, one, just set a goal, like start saving. Joe was spot on with that. You won't reach anything until you start. So set a goal, whether it's a year at an in-state school, if it's you want to be able to pay for 2 years at community college, whatever that goal is. Because again, keep in mind that when we're talking about college, we're talking about anything after high school. So 2-year, 4-year tech, trade, registered apprenticeships, 529s can be used for all of those. So you're not locking yourself in, but you need to start somewhere. So pick a goal. And the big thing I tell families is any dollar you save is one less you're going to have to borrow and pay back with interest, right? So the idea is get started, get something going. There's very low minimums out there. Don't always go with the minimum, right? Because you want to build those savings over time, just like Joe said, but set yourself a goal, get started. And at the end of the day, anything you save is something you're not going to have to borrow. That's the goal, is less student loan debt.
Exactly. And we've already got a couple of questions here in the Q&A, and folks, please do use this Zoom Q&A function, and we'll get to those questions kind of as we go along here. And these questions sort of work into our next topic here about why 529 plans are what we consider the best way to save for college at savingforcollege.com, and the flexibility. So the particular questions so far are, what's the maximum that you can save either annually, per month, or overall? So maybe, Marissa, if you can kind of speak to some of we mentioned the minimums, but maybe if we can also, discuss the maximums a little bit, and just, some of the flexibility that exists with the 529 plan and why it's, for most families, the best way to save for college.
Yeah, flexibility is really the word of the day when it comes to 529s. Folks want a number. I know a lot of people tuned in today hoping that Joe and I would say you need X dollars by X date. The beautiful thing about each plan is that you're going to have a high maximum. So that's generally going to range anywhere from a 250,000 to, I think it's north of 500,000 in some states. The idea is each state sets their own maximum, and that can be what a beneficiary has in all of their accounts combined. And so when you're thinking of what does 4 years of school look like, what does 7 years at school look like, those very high maximums that you can save. From there, you're going to go to, okay, well, what can I put in a year? The current amount that you're not going to face a tax on is $16,000 a year. That's the federal gift tax amount. But what I want to remind folks is there's that distance there between, okay, well, she just said I could put $16,000 a year in. You can put whatever you want in. It's your money, it's your account. But when you're talking about tax implications, the gift tax is 16, and then there's a maximum amount that you can have in there, which again is like a few $100,000. So look at your goals, look at the long-term kind of investment and what you're going to want to have in there, because once those accounts reach those maximums, you actually cannot contribute to those anymore once you've hit that amount. But really the key to it too is something else Joe mentioned earlier, is that it takes a village. 529s are super unique in that there are a lot of gifting platforms available. So you're going to go to something like UGift or even Gift to College, where you can put dollars in from friends and family. And in some states, you can even get the tax advantages that are on the state level for your contribution. So just a really amazing opportunity there. So really high maximums. There is the gift amount each year that you can put in, and then ways to let friends and family also contribute that are fee-free.
Yeah.
Excellent. There is a question actually about contributions, from elsewhere, and specifically, can contributions come from out of the country? And I don't know the answer to that one. I was wondering if maybe either of you two did.
General guidance for me would be if it can come from out of the country, it's got to come in US dollars to get deposited. So as long as it comes through in US dollars coming into the account, that would be my general understanding. Not something that we see very often, but I think most people that live that are living abroad, if they've got relatives here, they'd probably have some type of account that could fund it from a US bank, or at least in dollars from a bank abroad.
Excellent. And Joe, also, the $16,000 gift tax exclusion, is that per household or per account for the children? And also, are they able to contribute more if they are married, filing jointly?
Yeah, it's a good question. So that's just the gift tax, and we apply it to the 529, but it's really, you can give up to $16,000 to anybody you would like. You can send it to me if you would like, actually. Everybody on the webinar would be great. But you can choose to give $16,000 to anyone, and that's the annual gift tax. So you could, if you're an individual, you could give $16,000 to several different people. If you're a couple, that number does go up to $32,000. And the other thing about with 529s, there's the ability to super fund. You can actually advance fund up to 5 years. In 1 year. So you could write a check for $80,000, and then that's counted as your gift tax exclusion over a 5-year period. So it kind of starts that clock on a 5-year advance gift. So that's something that is often used, grandparents maybe for estate planning. When we talk about like these super funding ideas, a lot of times that is an estate planning strategy, because once it goes into the 529, it's a completed gift and it does come off of your estate. So those are kind of more advanced maybe than we're getting into today, but there are some ways to get additional dollars, like you said, being married, and then those advanced gifting of up to 5 years without disrupting anything over that gift tax exclusion. So there's some, and I am not a tax professional, so I will give that. I am a financial planner, a certified financial planner, but those things you would want to work with your an accountant to make sure that you're staying within those limits and doing what's best for you long term.
Excellent. And while we're on the topic here of kind of multiple children and long-term planning, this is a question that comes up every single webinar, and it's a really good one. I think it's really interesting to talk about. And it is, do I set up an account for each child, or do I want to have one account for my entire family? And so I'm curious here, Marissa, you're saving for 3 nieces. What did you consider, and what did you end up choosing?
Everyone's separate, because finances are a very personal decision. And so even saving for education, you want to think that through too. So practically speaking, I love to throw a little cash in on birthdays and holidays. And pretty soon it'll be when they start getting those report cards. And that way, when you have it separate, you can literally gift it to the child. Also makes using platforms more easily, like I mentioned earlier, the UGift and different options where you can put gifts in. Having it one child and name attached to that account makes gifting super easy for holidays, birthdays, celebrations, things like that. Another thing to keep in mind, if you're going to save for multiple kids, you've got to think about the time horizon for that. So if the kids are close in age, that may not be a problem. But if you have, stair-step kids or grandkids and they're, a few years apart, you want to think about, when someone is 4, you're saving for a 4-year-old very differently than you're saving for an 8-year-old. And if you put it all in one account, you're kind of tying your own hands there. And then fast forward and it's time to use the money. If the kids are super close together in age, you can only change the beneficiary every so often. I think it's like once a year. So if you have to make a distribution and then hurry up and change it to the other sibling, you're going to kind of cause yourself potentially a little bit of stress there. So I personally choose to save individually for the kids in my family. Again, it's a personal decision, but you want to think through time horizon for your investments. You want to think through the gifting and how kind of cool and fun that is for family. And also, man, when it's time to use those dollars, am I going to be able to get them out seamlessly, or am I going to have to move some things around? So I realize I've got some bias in that. Joe, is there anything you'd add there?
No, I'm a big proponent of attaching it to each person, because like you said, the goals are different. If you're starting to fund, let's say you've got a 3-year-old and a 7-year-old, like the amount you want to save, if you want to have the same pot of money with inflation and investment returns. You want to kind of create this. So you might need to save more in the older students than the younger. So I'm a big fan of, I call them buckets. People could seem to understand, like we want a bucket of money that's there. And when that 3-year-old goes off to college, it's going to cost more than it's going to cost when that 7-year-old goes off to college. So the investment, as well as the inflation and the cost of college, attaching those and understanding like the investment, what's the risk appetite for each one. I think we're going to get into that, but that it's really
and let's jump into the investment options. We'll of course get back to the qualified expenses because that's a huge topic in and of itself. But since we're on this, maybe if either of you could talk a little bit about what a menu of investment options typically looks like for a 529 plan, and what kind of considerations people should have when they're making that determination.
Sure. So I think that, generally speaking, from the state's perspective, you're going to see, we'll go with buckets, kind of 2 buckets of investments. You're going to have a year of enrollment or glide path option where it's similar to a target date investment for your retirement. Kids are going to go to school in 2036. Maybe that's the one that you pick. And what happens is those dollars are managed for you. So I'm not going to say set it and forget it, because you should never forget your investments, but you get in, you get started. And what happens is those dollars are invested over a variety of investments for that time period. And then as your student gets closer to using those dollars, again, anything after high school, 2 or 4-year tech trade, any of those qualified expenses, those dollars become more conservative in investment so that you have less risk. There's always risk if you're in the market. And we'll talk about FDIC insured later, but there's always risk if you're in the market. And nationally, you do find a bulk of both advisor sold and direct sold products in those year of enrollment portfolios with glide paths that are professionally managed for you. The other bucket is going to be individual portfolios. If you're a little bit more savvy, you're like, I want a little bit more control in this, and you can pick individual investments. And just like anything else, you're going to go in and you can pick from all of it, and you just got to get your percentages to 100%. So you go in with your personal comfort, what your investment risk, as Joe mentioned earlier, is, and your appetite for that individual child, and you go in there and you make the selections. And the cool thing is you actually are not locked in for eternity on those investments. You can change them up to twice per year. It's not a lot of exchanges, but just like everything else, the market's going to do what it's going to do, but you do have that flexibility there with your year of enrollment or individual portfolios or a mix of each with up to 2 calendar year changes.
Yeah, the only thing I'd add there is you mentioned the state, and so people may not be familiar that each state has their 529 that would administer be the right word.
Yeah, that's a good. Yeah, we administer the program, correct?
Right. So you're with the Indiana plan, and the big thing there is to understand what your state plan is, and if there's any tax benefits when you're looking at investment options as a whole. You want to look and make sure if there's any tax benefits within your state. I do a lot of work with clients in Ohio. There's a up to $4,000 that you put in, you get a state income tax deduction. So that's just an example. So check with your state's plan, and then underneath there, if there isn't anything in your state, you're actually open to use whatever 529 plan that you feel like has the best investment options for you. So I kind of start with, is there any state tax benefits? And then you actually can, and we can talk about the flexibility of distributions. You don't have to use your state's plan. You can choose to use another state's plan, but I give that caveat that if there's any state tax benefits, you want to make sure that you check those first and weigh those if it's worthwhile, and then what the options are underneath. So,
and Joe, that's also a common question that's coming through here, both in the registration and also in the Q&A here, is how do people choose the right 529 plan? Now we know that there are state tax benefits, so that's the first thing to take a look at. But I live in Florida. We don't have a state income tax. So how can I, evaluate my options for a 529 plan?
I would go to savingforcollege.com and use their awesome tools that they have to compare and contrast what you would like. But I think, high level it is, some people are familiar with and have, maybe your 401k plan at work, you have T. Rowe Price or Vanguard or whatever that might be, so find, maybe I personally look for low cost passive funds that mimic the indexes. So that's a lot of what we would do personally. But if people like active management versus passive, those are choices you can make comparing 529 plans. So those are the kind of things I would look at. And understanding that you do have choices. So if you don't have that state tax benefit, go find the fund managers that you like and a portfolio to create that you feel like is going to give you the best investment opportunity. So, and then Marissa, you might want to talk to just like, the guaranteed versus, we talked about glide path versus picking your portfolio. Those things are important. I think the one thing I would say when you're looking at investing though, is understand that college costs continue to rise. So, you want to be cautious if you've got a long time horizon, you want to make sure that those investments at least keep pace with the inflation rate of college costs. If college costs go at 3 to 4% and we've got 15 years to get there, we want to make sure our investments hopefully give ourselves a shot to get, at least meet or exceed that inflation amount. So.
And Joe, there's a follow-up here, because you mentioned you'd be looking for a low-cost plan. Could you maybe break down what kind of fees plans charge and how people can see that?
Yeah. So again, I think when comparing plans, Saving for College does have some of the best tools out there, but you want to look at, are there any upfront costs? Are there any administrative fees on the plans? Most of the plans typically these days don't have much cost just to be in the plan. And then you want to look, is there an upfront cost? Is there an advisor sold plan? Is there a load to get into those funds, or is there an additional fee for the investment management? So there are layers, I call them layers of the onion. I like to use analogies, but like there are with fees, layers of the onion. Who's the fund manager? What's their compensation? Is there any compensation going to an advisor? And fees isn't the only thing to look at. But you do want to be conscious of fees. So all things being equal, paying less fees is probably better for you as the end user. But making sure it's about diversification as well. So you want to build a portfolio that's appropriate based on your time horizon, and then look at what are the fees associated, because anything you can save there, it's going to work to your benefit.
Excellent. The last thing I wanted to touch on with the investment options, Marissa, you'd mentioned the FDIC insured options, and there were actually a few questions in registration and in the Q&A here specifically about that. So I was hoping maybe you could speak to what you guys do at College Choice CD and how that's different from maybe some of the other investment options that we've been discussing.
Absolutely. There's kind of two sides to that story. So the sponsor today is specifically our CD plan, which is it's certificates of deposit, right? Good old fashioned CDs. And those have seen a terrific bump. Actually, when the Fed raises rates, the rates go up on CDs. And so, you're going to see anywhere from, well, I don't even want to give you a range, but they're very attractive right now. But a certificate of deposit is going to give you like a 1, 2, or 3 year lock in at a rate. And there's also savings accounts for that. So to think about something that's FDIC insured, it means it cannot lose value. So you're going to have folks on the call today who absolutely want to get the most out of their account, high risk, high reward. Let's get those state tax credits. I want that tax-free growth. They're folks who are likely going to find something that's in the market. For folks who want to save but do not want any risk, they may be interested in something like an FDIC insured CD. When you're in things you want to look at for this, kind of like when Joe was talking about some of the important things for investments, you want to take a look at what the minimums are, because some of those can be $25 a month or $50 a month. So what's your budget? What are you able to do? Are you okay locking your dollars in, but know that you're not going to lose those? The second kind of piece to that is, I would argue or assume, however, the wrong word is there, almost every single 529 plan is going to have an FDIC insured option built into it. So when you go to these, you go to Saving for College, or you check your home state's plan, take a look around, dig around in the investments, look under the hood, if you will, and see what's out there. But everybody's going to have either a savings option, capital preservation, something where there's very little risk. The cool thing about some of the CDs is some that are fee-free. And if you're in a program, there's going to be some sort of fees. And just note, like, you're not going to get a bill for that. It's going to come out of the dollars that are in that account. So if you're sort of like, how does it even work if there's a fee? And it's not a monthly invoice. It all comes out of your investments. But all of this is super transparent. Even though it may feel complicated, just keep clicking through on these websites. And you can see all the fees. Most plans will have information out there that says, hey, what does it cost to be in this portfolio for a $10,000 investment? And it'll tell you what it's going to cost you each year and what the total is in those fees. And so I know you guys are all getting a lot of information today. Just remember to take a breath, don't panic and just keep clicking through and take the time with the information until you feel comfortable with it. But yeah, FDIC insured options are fantastic. Almost every plan has an option like that. And then the city plans are going to lock those rates in, and they're really attractive right now.
Thank you so much, Marissa. And just the last thing I'm going to say about investment options, there was a question, can individual stock be bought in the 529 plan? And that is not the case. It's going to be some sort of a mutual fund or ETF that's within the investment option.
Correct.
So
I think
let's,
the thing, oh, sorry, Mark.
no, go ahead,
The
please.
thing to remember is we're not out here to make a bunch of money. It's the state, right? So the states are here. The idea is we want to get our residents saving so that they're borrowing less later. And so what we do is we have limited investment options. We don't have a ton of portfolios. You are always going to see more options in an advisor sold plan than a direct sold plan, but these direct sold plans, and I know a lot of you all already have them, are set up for everyday folks to be able to get in there and invest, and they shouldn't be scary. So just take your time with there, and you're not going to go in like when you're picking for retirement and have 800 choices. You're going to have a half dozen, maybe a dozen, and all the details are going to be there about those. So just know that they're set up to be simple and to be user friendly.
Yeah, and the other layer there is like, if you're not comfortable with like investing in the market, the states have built these plans so you can't really get hurt too bad. There's nothing crazy aggressive. They're like pretty, you know, I call them vanilla mutual funds, and that's a good thing, because if you're getting started and haven't really invested much, these age-based plans, it's professional money managers who have said, hey, if I were to invest dollars for my kids, this is how I would invest them when they're 5 years old. And then when they get to 15, 16, it's more important that we have less risk to them because we'd rather have it than have it go down. So, you know, that's really how they're built. So again, if you're really looking at getting started, those age-based plans with the glide path to them are a great way. Just start something. Don't be intimidated by the investments, because they are really built by the state and the money manager to give you what they would do for their own kids. That's how they're built. So hopefully that's helpful.
Thank you both. And I'd like to even go a little bit further there and take a little bit of a step back. In, you know, 3/4 of the folks who are joining us have already opened the 529 plan, but there's still a quarter that have not. And we do have a good question here, saying that the process can be very overwhelming and discouraging, and that it's difficult to figure out the first step and where to start. Do you go to a bank and ask for a 529 plan? And how long does this process take? What kind of documentation are you required to have? So maybe if you can kind of speak to the ease of setting up a 529 plan, I think that would be really helpful, Marissa.
Absolutely. So with most states, honestly, you can get started in 10 minutes and do it all online. You're going to need your home address and social security number, or ITIN number. You're going to need the same thing for your beneficiary, just their mailing address. It needs to be an actual physical address and not a PO box. I don't think there's a state you can open a 529 in without the physical address. So date of birth and social security number. You're going to be able to go in, enter that information, and it's going to ask you to pick your investments. And this is the point where most people kind of freeze and they're not sure. But take a few minutes, click through. There's a prospectus for each option out there. Now, I'm going to go ahead and jump in and say that, you know, looking at last year's returns are not going to guarantee your future returns, right? So that's, the market is where it is. But click through, look and see where you're comfortable. You want to make sure that the more information that you arm yourself with, the better prepared you are for making those investments. You can absolutely ask your friends and family. It's one of those things you can kind of answer shop or get some advice, but it really is you sitting down, deciding what is my appetite for risk? What are the benefits of doing this? But I will tell you, the thing that I hear most often is it's parents who say, or grandparents or aunts and uncles, I wish I had started sooner. So I'm not here to push you into something, but I am going to say the biggest regret we hear in this industry is, man, I just wish I'd started sooner. And that's not to deter late stavers. It's never too late to get started, but you want to get in. You are going to need a checking or savings account to have those funds drawn for. So back to what you need to have. But just get in there and kind of get started, and just know that, again, as Joe said, these aren't set up to be complicated. We want you in. We're going to have some pretty simple choices for you based on what your investment risks tolerance is.
Excellent. Thank you so much, Marissa. So, you know, one of the most popular questions around 529 plans is, what can I use this money to pay for, right? And there's some obvious choices, right? Like tuition bills. But there are also some less obvious ways of using 529 plans. And also recently, it doesn't necessarily need to be a college, right, that you're using this money for. So maybe if we can start really broadly about the different types of education that we can save for, and then we can talk a little bit more about specific expenses and strategies to make withdrawals there.
Yeah, Marissa, I'll let you start and I'll add some color if I can.
Perfect. Yeah. So really, 529s are incredibly flexible. It's why they're one of the best tools, leading tool in the country to save for higher education. So obviously tuition, room and board, if you at least have time. The cool thing about housing is you can use off-campus housing. The student just has to be enrolled half time. And for how much you can use, you just look at the cost of enrollment on the university's website. They'll have a number listed for housing, and you can use up to that amount for your student if they're enrolled. You can also use it for computers and the equipment to go with that and required fees. So all the big ticket items you would expect can absolutely be covered with a 529. Joe, what am I forgetting?
Different majors come with different expenses. So like you mentioned, the computer, or if like you're an art major, you can absolutely, anything that's required for you to go through a course at a university, you can utilize those funds for. And also like the meal plan at school, like again, the same as room and board, whatever that is, a meal plan, you could still say, hey, I want to give, $200 a month from my 529 directly to my student. They're not going to eat that on campus, but that's absolutely still, it's really like whatever those direct costs that can be billed from the school, even if you're not sending that check directly to the school, that's the amount you can pull out of a 529 for room and board, books, fees, supplies, all that stuff. So couldn't be, I don't think it could be more flexible. The caveat there is always like, can I buy a car with it? And the answer is no. Like you can't go buy a Porsche with a 529 plan. That's the big one we get questions about is transportation. That's kind of one of the big, because that'd be, I think, too broad. So they kind of set conditions out.
Yeah, some of the no's, right? So no transportation, not the planes to and from. Right. Their health insurance. That's not a cost of education. That's just a life thing you need. So no, that's not covered. And I felt like there was a third I wanted to throw out there, but yeah, no travel or health insurance, or even the cost, like the application fees. They're not going to reimburse you for the cost of getting in. It literally has to be, this is what I'm tied to my education, and not out there on the peripheral.
Yeah. And I think like if when you're in accumulation, when you start to distribute, it can be intimidating. When you start, you've saved for a lot of goals. For most people, paying for college is the first time they've had to decumulate savings. So how does that actually work is a mechanical question most people have. So with most 529 plans, they now have the ability, if you want to send a check directly from your 529, they'll send it directly to the school, attached with your social security number. That's another reason to have the plan for each student. Keeps that very simple, goes to the school, they know who it's for, etc. And then for those expenses outside, you simply will say, hey, I'd like $1,000 sent to me at my home, and I'll keep track of what those expenses are. So that's important. It's only really in the form if you were to get audited, but it's important that any of those expenses you can validate were for college, all those things we just mentioned. So either sending it to the school, I always find is the easiest, but you can absolutely have it sent to you, keep receipts, keep track of what it was used for. And that's kind of the two ways really that you can have the 529 plan distributed. So it's pretty simple, but it is intimidating. So there's a little sting. People are going, gosh, I've saved all this money. What do we do with it now? I think the college savings plans have done a great job of making that very, very easy for you. And you can always call them for your first one and ask for help. They're pretty friendly folks.
Yeah, so to recap, just for someone who maybe got a little confused in that, you can send the money directly to the school, which is super easy and clean. You can distribute it to the account owner. Sometimes you can distribute it to the Benny. But at the end of the day, it's cleanest to go to the school and just keep a copy of your receipts. When you go in there to ask for the money out, it's literally going to ask you, is it qualified or non-qualified? You don't have to show a receipt. You don't have to, prove all these things to get your dollars out. You have that folder ready with all those receipts in it, should you be audited. The thing to really remember though, in that whole period, is to make sure you're taking that distribution in the same year, the same calendar year, not academic year, the same January to December that you had that expense. For it to be qualified, you have to take the withdrawal in the same calendar year. Now that can get super confusing if you're trying to take a withdrawal at the end of December for something that's due in January. You don't want to do that. Not that I can give advice, But I want to be really clear that distributions need to be taken in the same calendar year as the expense.
Yeah, that's important because there's that difference in academic year versus calendar tax year. So you got to be mindful of that. I'm very mindful.
But it's not scary to use it.
No.
We're glad to get the money out too.
Yeah, thank you for making that point, Marissa, because I think that's really important to remember. So a couple of follow-up questions on specific items, whether they're qualified or non-qualified. Firstly, things like club or team extracurricular fees. We've gotten questions in the past about fraternity or sorority dues. Where does that stand in terms of a qualified expense?
Sure. So a due is not a fee. So while you could live in the fraternity or sorority house, because that's room and board, that would potentially be a qualified expense if you're half-time. However, a due is not a fee. Those are legally different things. Extracurriculars are extracurriculars. That's not academic. So you're just gonna use it for tuition, room and board fees. You want to be careful of those gray areas. IRS publication 970 is fairly helpful for what's qualified. Now, I will warn you, you're going to get a little frustrated when you go looking for the list of qualified expenses, because we've already kind of hit everything today that's out there because they're broad or super specific. So if you're looking for something and it doesn't make a lot of sense, if you try to look at those original buckets, don't overthink it and see if it fits there. But yeah, no extracurriculars are covered.
Thank you. And what about foreign schools? So I can go ahead and kind of answer this one. But so long as it's an eligible institution from the perspective of federal financial aid, you would be able to use your 529 plan. And you'd also be able to use it for study abroad. So that's a popular use of the 529 funds to do study abroad.
As long as that check's going to an institution that takes federal financial aid, and that's the litmus test, right? So even, do I have to be getting a 4-year degree? Can I take a class? The litmus test is an eligible institution is a school that takes federal financial aid. If that box is ticked, you're heading in the right direction.
Yep. Any accredited. Yeah, that's important. So, and that distinction, like you said, if you're half-time, that's when you can also go to room and board type stuff if you're at least half-time. So that's an important distinction.
Well, I want to jump in a little bit. So we talked about the half-time. Something that's brand new to 529s is registered apprenticeships. And so for an apprenticeship account, it needs to be registered with the U.S. Department of Labor. Now, those programs are going to be very different compared to a 4-year degree or a 2-year degree. You know, a lot of them come out with associates. But you're going to see those definitions of what's a fee, what's equipment are going to be in those program guides. So make sure if you're thinking about using an apprenticeship or your dollars for an apprenticeship, which is a great way to kind of get in and get out with less debt. You can just make sure it's with the U.S. Department of Labor, and then the campus will have more information on that as well.
Excellent. So Joe, if you've got a limited amount of 529 funds available, meaning you're not going to be able to cover all 4 years of education, do you recommend spending them all at once in the first year, or using it little by little? And the user mentions that they've heard several answers to this, and I think as have we. So what would you say here?
When you're looking at what I encourage people to say is, how are we going to pay for all 4 years of college down to the penny, including what types of loans and what's our loan payment going to be when we're done? And what are we going to make with that chosen major? So that's kind of my general framing. So you literally want to have a roadmap of how to pay. So it's not just 529s, it's 529s, cash flow. What about grandparent or outside help? And then what's the smart lending strategy? So those things become important because that's going to help you determine how do we spread our 529. The temptation for a lot of families is we'll just use a 529 for year one and then we'll figure out years 2, 3, and 4. When a better strategy is to understand, particularly the federal direct student loan, it's use it or lose it each year. And that's one of the best loans you can have. It's $27,000 max over 4 years, but it's $5,500 for your freshman year, $6,500 for your sophomore, $7,500 for your junior, $7,500 for your senior. So the key thing there is, like I said, is it's use it or lose it each year. So if you burn all your 529 and don't use that, it's the best loan you can get. Make sure you understand what your loan strategy is. Coordinating grandparents, I know that we might get into that, but any outside help. So And then cash flow is another big one. So literally figure out what can we cash flow towards college, $200 a month, $400 a month. So all those components, and literally map out all 4 years is what I recommend. It might be if you've got a very small amount in there, but a lot of times you do stretch it out. But when you have qualified higher education expenses, you really want to consider, do we exhaust that all at now that we know we have them, or do we spread it out? So, but I just really, it's a roadmap of here's all the things we're going to use, including the loans, and then here's the 4 years of how we're going to do it. So hopefully that's helpful. Literally just here's the line items, how we're going to plug them in each to make the ends meet.
Thank you, Joe, for that breakdown. So just to break it up, give Joe a minute to breathe here before we get into 529s and financial aid, because that's always a fun topic. I just want to go into a couple of these questions that we have here in the Q&A. One was from an individual who lives in New Jersey and said that they do not have a state tax benefit for 529 plan contributions. That is recently changed. There is now a deduction in New Jersey for those with incomes up to 200,000. So please take a look at that. And there's also a question here, does one typically have to be the owner of the plan to get the state tax deduction? So would they be able to contribute to somebody else's plan where they're not the owner and still generate a state tax deduction? Maybe Marissa, you'd be able to answer that one.
So that depends on the plan and the state, but you can literally put that in the Google and it will tell you whether or not. I can tell you in Indiana, you don't have to own it. We actually have a credit worth up to $1,000 a year. And so when you've got grandma, aunt, and uncle, and everyone throwing in some states, so example is Pennsylvania has parity. You don't even have to be in Pennsylvania's plan in order to take advantage of their deduction. So those are some pretty specific terms. So I would just pop that in for your specific state. I'm sure Saving for College also has it on their Super Savvy. They have this really cool map, and it shows you what the value of the tax credit or deduction is on each state. So I'm sure New Jersey's already out there, but take a look and see what it looks like for you in your state. But it's just going to depend on that state. Because I run a specific state, I can't tell you about the rest for sure.
Yeah, and folks, a lot of 529 plan features and rules are on a state-by-state basis. So I'll make sure to include a link in the follow-up email to a page that you'll be able to select your state and see the exact details of your state's plans and any tax benefits that are available, because I think that'll be really helpful. So, Joe, the FAFSA.
Yeah.
When I looked at the list of when I looked at the list of registration questions, I mean, it just popped out to me: financial aid, scholarships, FAFSA.
Yeah.
So maybe you can just go ahead with this one.
Yeah. The FAFSA is the free application for federal student aid. I call it the tip of the spear from a financial aid standpoint. It is, the FAFSA is what you file. It drives the federal formulas. At the majority of schools use that to determine your eligibility for need-based financial aid. There's a lot of pending changes. So depending on the age of your students, what's true today will not be true next fall. So there's the FAFSA Simplification Act out there. But in general, the FAFSA is what you fill out. You put in your income and your assets of the parents and the students, and they're going to tell you what they think you can afford. That's the simplest way I know how to describe that. So the big thing that they're looking at is they're looking at your assets as of the day you file, and they're looking at your income from 2 years ago, basically. So if you're going off to school in 2023, which you're filing now, like they're looking at your 2021 income, right? So in big picture, because we don't have time to get into all the details, with your assets, they want at most 5.64% of your non-retirement assets. So mutual funds, stocks, cash, all that kind of stuff, 5.64% is the most that they want from that per year. So now that's called the expected family contribution. So that's what your family is expected to be able to contribute based on your income and your assets. From your income, they want roughly 20 to 25%. Is a good general rule of thumb. 20 to 25% of your income is what they want, and call it around 5% of your non-retirement assets. That's the big ballpark. And so if you have, let's say you have $100,000 in 529 plans, they would want at most $5,600 towards college next year. So in the 529 plans, also it's 529s if you're a parent and you have 3 for all 3 kids, And they all have 25,000. The number that goes on the form is 75,000. It's not 25 because you own that, and you could change to the beneficiary at any time. So as we've been talking a lot about 529s, I get that question a lot. So the big thing I will point out is that the asset of a 529 is a parental asset. And the reason that's important is because that's one of the most common mistakes is people say, we've got 25,000 for junior's college, it's his asset. The student assets are assessed at 20% as opposed to 5%. So that's a very common mistake. You always, even if the student does own it on the FAFSA, it's still reported as a parent investment asset. So those are a couple, hopefully high level, and then a couple of the mistakes we see that can really disrupt your financial aid opportunities.
And this, folks, is why we, consider a 529 plan to be advantageous from a financial aid perspective. If you just save that money in your child's savings account, that's now going to be reported as a student asset. So it's going to be assessed at a much higher rate. So what about scholarships? There's a really, nice provision around scholarships in 529 plans. That's also a very common question. My child's going to get a full ride. What happens then?
Yeah, Marissa, you want to take that one?
Yeah, so scholarships, they're great. You're not going to be penalized for a scholarship. But if you take the dollars out for a scholarship, which you have the right to do. So if you get a scholarship, you can take the dollars out, dollar for dollar, that the scholarship that the student received. But you will pay state and federal income tax on the earnings portion of those investments. And the reason is we're not penalizing you for receiving that scholarship. However, if those dollars, because it's not for education, you do have to pay state and federal income tax on I believe, is it just the earnings portion, Joe, for a scholarship?
Just the earnings portion. Yep. So if you, and when that any distribution that comes out, they're going to look at it on kind of like a pro rata basis. So if there was, let's say you had $10,000 total in your account and you chose to take all that out. If you'd contributed 7 and 3,000 was growth, that's what, whatever pro rata, if you took out 1,000, it would be $300 worth of growth and $700 worth of principal. So whatever you contribute, you're never going to get taxed on that again. But any growth inside of that account, if it's non-qualified, just strictly non-qualified, you're going to pay state and federal income tax as well as a 10% penalty. So, and that's the beauty of the scholarship is you avoid the 10% penalty, right? So, and trust me, I've never met a parent that was like, gosh, I got to pay taxes. You're like, well, yeah, but you got a scholarship. That's the good stuff, man. So like, be glad to pay that if you need to. But that is a very common question. What if we get scholarships? At least you're going to do is you're going to have tax deferred growth on that money for, however long it was in there. And then you'll just simply pay the taxes, which I would say gladly do if you got a scholarship to offset it. So.
Great. And what if you do have some leftover money in the 529 plan, not as a result of a scholarship? What are some other options? This is also coming in quite a few questions. What can we do? The children have already gone through undergrad, not going to graduate school. What are our other options with this money?
One of the cool benefits of the 529 is there's no time limitation on it, right? So you don't have to use it by a certain date, by a certain age, so you can let the dollars ride. So yes, they're done with school now, but what if you just want to keep that invested for a while? Maybe they can go back to school later. Career changes, how many people are on their second or third career, and you may need some training up, some retooling. Those dollars can still be used there. So one is just let it ride. Another option is you can always change the beneficiary on the account to another member of the family. So member of the family is actually a term defined by the IRS. And how you got to think about it is you start with the original beneficiary on the account. You can go out as far as first cousin, and steps count. So maybe there's a cousin that you want to pay for books. You can just change it to another member of the family, because the key in this space is using it for qualified expense. Like Joe said, I mean, I wouldn't be mad about paying income taxes on the earnings for a scholarship, but wouldn't it be great to not pay any taxes on those dollars that you've already put in there? So let's find a qualified way. Something that I like to talk about is making it a legacy account. So the industry just turned 25 years old last year. So what that means is now we are knocking on the doors from grandbabies with some of our early adopters. So you can absolutely leave that account open, leave it the name it's in, maybe look at your investment horizon, see if you do anything with the investments, but you can absolutely keep that open and keep saving for future grandchildren and make that a legacy account for your family, where you have these education dollars there ready for your family to use. So again, planning ahead, you've already got the dollars invested, and let's set a legacy up for our family.
Yeah, love the legacy. It's we talk about tax deferral, but if you haven't looked at like a comparison chart of tax deferred versus taxable, having it grow tax free for 30 years, I mean, that $5,000, you've got a nest egg now for your grandkids. That's pretty awesome. And then the other piece is there is now the ability, if you have leftover 529, you can use that to pay off up to $10,000 of student loans. That's very new, and that is state specific. So some of these rules we've talked about with apprenticeships, with this ability to use up to $10,000 to pay off loans, the state has to approve that. It's at a federal level, they've made it. But Marissa, maybe I don't want to get too technical, but the state chooses if they want to adopt what's passed down from the Fed. So don't just assume that your 529 plan has each of these provisions. You want to make sure state specific. So I don't know if you want to comment on that a little bit, some of those provisions.
Yeah, I mean, you're spot on with that, Joe. So this is the part where we like to speak broadly because a 529 is a vehicle at the federal level, but then all the extra perks are at the state level. So that's where you're going to see things like, whether or not you can do student loan repayments, whether or not registered apprenticeships are counted. So again, always take a look at your home state's plan first, just because there's going to be benefits there. If there's going to be anything that you're not sure about, it's going to be in your state. So just put those terms in. But some states do not count student loans. So you're going to face penalties if you use those dollars for student loan repayment. And the best place, and this is also the scariest place, but the best place to take a look at that for yourself that you're already going to have, if you have a plan, is in your disclosure booklet. So everything is in your disclosure booklet that has to be the plan that you're already invested in. You just open up that document. It'll be a big old PDF. I'm talking 100 pages. And do the control find. I hate to be so simple about it, but that is what I do on a daily. Pop that term in, pop in student loans, and just scroll through or K-12 or apprenticeship. And you can easily find the actual, and that's like the source material, we'll call it, for how your state treats it. Now, you can also go to savingforcollege.com. They're going to have resources out there. They're going to tell you which states do what, but I want to teach you to fish. And if you're in a plan already, you got to start learning to navigate that disclosure booklet. Everything you need to know is in there. And if it's not, make sure you're not overthinking it. Because again, like, oh, well, can I use it for this thing? Well, does it fall into one of those buckets? And is it an institution where you can use the dollars? Like sometimes you have to back up and you get panicky. And it's okay. Again, these are investments. Investing is scary. But just take some time with that disclosure document, because you tick the box, you say you agree to it when you open the account, just like when you buy a vehicle or get a mortgage. So just take some time getting to know that document. But I find the word search super helpful.
Yep. Yeah, I think you mentioned something that's important. Don't get analysis paralysis on some of these kind of obscure provisions we're talking about, especially if you're saving and accumulating towards college. I've been a financial planner for over 20 years, and I think I can count them on one hand, the number of people that had money left over. So, so
even need a whole
a sibling so a sibling or a cousin or somebody's going to use those dollars. But just kind of want to point out some of those things once you get out there. If you got money left over, great. Just figure out what's the best option for you.
And Joe, I think I want to tag on that too. So we're talking about kids and siblings, but you're an adult. What if you want to go back to school? You can absolutely use this for adult learning. These are not just for kids and babies. If you're sitting here thinking about an MBA and your state's got a tax credit or deduction, and maybe your work does tuition reimbursement, like, let's quit borrowing all this money and just worrying about how we're going to pay for it later. Let's say if we've got somebody left over from the kids and the wife wants to go back to school, let's take a look at those dollars and let's see if there's a way that we can make those work harder for us. As an adult, if your work does some workplace reimbursements or whatever, but you can also not just go out to first cousins, but use it back for the parent who saved it to start with. So lots of options there for adult learners as well as kids.
Yeah, I'll tell you a real life example. I have a client that's actually taken some culinary classes at the local community college out of the 529 plan. They're taking a soups and sauce class and a cooking class. So I was like, she's like, can we use this? I was like, yeah. So that was kind of a cool way, something you can do later in life. I've heard some golf classes can actually be used for. So
Right, because remember, the litmus test is, does the school accept federal financial aid? And if the
Yep.
school accepts federal financial aid, we're not going to nitpick as to whether you're taking welding or these cooking classes. You need to be at an institution that's qualified. And then there's so much flexibility there
Yep.
to really skill up for today's marketplace.
Mhm.
Excellent. So a fundamental question here. We've been talking a lot about how the different states have different rules. So if I am using my state-sponsored 529 plan because I have a tax deduction available to me, am I limited to using those assets for an institution in the same state?
Not if you're talking about after high school. So college universities, absolutely not. You can use it at any school in the US or abroad that takes federal financial aid. We're talking, there's over 400 international schools that you can utilize a 529 for. But just because you're in, Alaska's plan or Nebraska's plan or Indiana's plan, the beauty of what we do, and we're all friends, right? The administrators of all these plans, we all work together. But you can use those at any schools. Now, where you may fall into some things are the student loan repayment, K through 12, those things that are not higher ed. What happened is some legislation was passed on the federal level, and then all of a sudden the state's like, wait a second, how do we feel about that? And so that's where you're going to see the differences is for those kind of extra uses. But for higher ed, you're going to see that across the board that you can own any state's plan and you can go to school to any school that takes federal financial aid. You're not locked into your state.
Excellent. Thank you so much for that, Marissa. Just here, a question about the minimum to start a plan. They range by state. I'm not sure, this specifically was New York, and I'm not sure what the specific minimum is there, but they range from $10 to $25 for a typical direct sold plan. So they are really quite low. So last topic here while we have a few minutes, not just grandparents in 529 plans, that's the most common example, but Marissa, you're not saving for your nieces. And there are other people saving for other loved ones. What are some of the considerations, some of the financial aid impact maybe we can touch on a little bit, Joe, but what should those kinds of people be thinking about when they're saving for people who are not just their child?
Well, I think so I'll start and you can bring us home. Yep. I think we tend to say grandparents, but that's anybody who's not the parent, right? So again, there are lots of aunts and uncles out there who are either already empty nesters or chose not to have kids. So they may have a little bit of extra money. I like to think about the parents are actually the ones who are doing the diapers and the daycare and the extracurricular activities. So let's include the friends and families who may either have the income that's disposable or that is so important to them to save, right? So I think for myself, being a first generation college student, I didn't have anything going in. I did it all on loans, which I was super thankful for, and they're all paid off now. But for myself, I knew that I wanted the girls to have the head start that I didn't. And I don't say that from a negative place. You're in the family you're in, you get the finances you have, right? So what you do is the next generation just does a little bit more. And so aunts and uncles, friends and families, cousins, coaches can contribute to 529s for these students. And then I'll let Joe talk a little bit because we've got some exciting news coming up in 24 and 25. But when you fill out the FAFSA now, it's going to ask what are the parental assets. Like, well, how do the grandparents and aunts and uncles count? And I'll let Joe talk about that.
Yeah. So right now, like when we look at the form, it asks for parents' assets, students' assets. It doesn't ask for grandparent or aunts or uncles or anybody else. So historically, the way this has worked with financial aid with schools is if that was dollars that weren't reported, let's say there's $10,000 that came into the school. They would say that wasn't reported. And we're going to count that as untaxed income to the student. And we're going to say 50% of that, we're going to take that off your financial aid the next year. So the way we used to get around that would be we would use, or still this year, grandparent assets or outside assets we would use for the last 2 years of school because income is a prior tax year thing. So that's all a bunch of gobbledygook that I just said. It's very confusing. But going forward, 24, 25 school year and beyond, dollars coming in from grandparents or aunts, uncles, anybody, any outside assets, they are not going to disrupt your financial aid opportunities. So that's a big change coming. So if you've been reading, this is all part of the FAFSA Simplification Act. Difficult for me to say, but this act is making some pretty sweeping changes. That's one of the big wins that we see as part of these changes coming to the formulas. So there's some losses too. The EFC is going to become a student aid index. It's actually a throwback to what it used to be called. So there's some implications there that I did a whole hour on yesterday, so that I won't go down the rabbit hole, but that's with grandparents. You can be confident that grandparents or aunts and uncles can hold those assets and it will not disrupt your financial aid beginning 24-25 school year and beyond until they change it again.
Yeah. So the two big takeaways, if you're like, okay, if I got to go and what do I need to know? Don't be afraid, because the absolute most that your parent-owned 529 is going to cost you is 5.64% of what's sitting in there. And as of 24-25, those third-party owned accounts, grandparents, aunts, and uncles, are not going to hurt you at all. So this industry continues to get more flexible. It continues to just be an awesome, awesome, powerful tool to help kids get through whatever school is best for them with less student loan debt.
That's it.
I think that's a great way to end things. We are unfortunately out of time for today, but special thanks to our panelists, Marissa and Joe, and our generous sponsor, College Choice CD 529 Savings Plan. At this point, I would like to announce the winner of the $500 contribution, and that is Neil Dillard. So congratulations to Neil, and we'll be reaching out to you in the coming days so that we can get that set up for you. So thank you all for coming out here, taking the time necessary to understand these complex topics. Your children, your grandchildren, your nieces, your nephews are going to be much better off because of it. So we really applaud that. And I'll send out a follow-up with this recording, as well as some helpful resources and a survey. We'd really like to get your feedback on how we did today. So thank you all and have a wonderful rest of your day.
Thanks, Mark. Thanks, Marissa.
Thank you.